What's going on, guys? It's your favorite millennials coach here, Nader, and today we're going to be teaching you guys the perfect road to wealth that you can build out today. So in order to build your way to wealth, you have to define what wealth is. Wealth may mean different things to different people. It may mean that you have $10 million in your bank account and never have to worry about money. Some people may say that it's just defined by time and that you're not connected to a job. First thing you want to do is take some time to think about what wealth means to you. In my case, wealth means that I'm not tied to a certain job. I don't have to be up at a certain time. I don't have to be at a certain place at a certain time, and I can, down the line I can spend time with my family whenever I want, take my kids to soccer practice, to basketball practice, and that's what wealth means to me. So let's jump right into it. The first step to building your roadmap to wealth is defining what your assets are, your liabilities are, your expenses, and your income. What this means is that you need to know how much money you have coming in and how much money you have coming out. Your income could be from your side hustles, from any rental properties, from your investments, from your W-2 job, or anything else that's bringing you money. Your expenses include everything that's going out of your bank account. This includes your groceries, your mortgage, your utilities, everything that you can think of. Easy way to describe assets and liability is asset brings money into your pockets, stock, real estate, rental properties, whatever it may be, dividends. And then a liability is anything that takes money out of your pocket. So one of the trickiest assets or liabilities that many people disagree on is your primary residence. Some people say this is an asset because you build wealth over time. Every time you put money into your mortgage, this builds equity in your property, and so on. Other people say this is a liability because every month money is coming out of your pocket. You have to deal with maintenance, things break down. So that is something that many people disagree on. So a few ways you can actually understand your finances or where your income and your expenses are. Print out your latest bank sheet. This is what I've done, and grab a few highlighters. You can grab green, pink, yellow, whatever the colors may be, and categorize every single expense on that credit card or on that bank account. If it's income, highlight that green. If it's shopping, highlight that yellow. If it's gas, highlight that green. Or if it's a bill, highlight that red. Whatever the cases may be, pick a certain category and a certain color highlighter and go through your bank account and figure that out. This is the easy way to figure out every single dollar and where it's going. Many of you guys might not want to do this or even care to do this, so there are different ways to do this. Number one, I can help you out. We can get together and we can chit chat on how to do this, or you can take the automated way. Many credit cards like Chase that I use actually do this for you. They show you like a spending summary for your year or for the quarter or for the month. So once you go into the spending summary, it'll show you how much money you spent on groceries, how much money you spent on cars, so on and so forth. The issue with this approach is sometimes they miscategorize things. They may put car expense in shopping or whatever the case may be. So I don't use that too much, but it is good to give you an overall picture. But if you want to get, like I said, if you want to go into every single detail, you can print out those bank account statements, you can print out those credit card statements and so forth. Another way to automate it is a few apps. There's an app that I use called Mint. In Mint, it's a net worth tracker, so you can input all of your accounts. Your credit card account shows you how much you're spending monthly, your income through your bank account, your savings accounts, your investment accounts, and it shows you how those grow over time. So this is a really great app that I use. No, I'm not sponsored. I wish I was. One day I will be, but today I'm not, and this is just an app that I actually like, that I use personally. Another one that a lot of people use is YNAB, or You Need a Budget. I think this might be paid, so I don't really use this. I've never have used this, but do your research on that if you're looking for something outside of Mint or doing this manually. So once you have the full financial picture on what you're spending, where your assets are, where your liabilities are, where your expenses are, you need to create an overall budget. An easy way to create a budget is to follow the 50-30-20 rule, which I use myself. This means 50% of your money should be going to bills, 30% should be going to wants or guiltless spending, whatever you want to spend it on. And then lastly, 20% should be going to investing and savings. This is a rule of thumb. It's not set in stone rule that you must follow or that the government's going to come after you or you're going to be poor forever and have no money, but it is a very good rule to follow. This may vary from case to case. So if you have a higher income, your bills may be less of a percentage, your wants and your investing may be higher because you can afford to have less bills, or your bills take less of a percentage of your income. But if you make less income, your bills could be the majority of your expenses. So your bills could be 60%, 65%. And there's a few ways to adjust that. You can lower your wants, you can lower your investments, but you can play with that specific case to case. I like to follow as closely as possible to the 50-30-20 rule. It's a very good guideline and an easy rule to follow. So a good way to create and keep track of your budget is to create an Excel sheet like I do. Like I said, I'm a numbers nerd, so I like to have all that on your spreadsheets. I love Excel. I love making charts and graphs. Again, I can help you guys. If you guys don't like that stuff, I'll do it gladly. So reach out to me, we can talk. But build out a spreadsheet, have a column for your bills, put all your bills in there, Comcast, WOW, your car, your mortgage, utilities, and then put the numbers right by that. Next, you'll make a column for your investments. This will be 10% for your Roth IRA, 5% for your 401k, and then 5% for your savings account. However you want to break it up, just pull it all into Excel sheet. It's a very easy approach and an easy way to do this. Next, you'll have your last column, which is your 30% wants, and the most fun part because you get to spend this however you want. I don't really focus too much on the wants. I focus on the bills and the investments, and then everything left over is the wants. So usually I have my investments around like 22%, and my wants around 28%. But like I said, this varies from case to case. So now once you've created a budget, you've understood your expenses, where your money is going, how much money you have coming in, the very first step everyone needs to take is build out an emergency fund. A scary stat that I saw earlier this week is about 73% of millennials are living paycheck to paycheck. They're one car breakdown, they're one medical expense away from being in debt, or they may already be in debt. So the most important thing to your financial health is building this emergency fund. An emergency fund is a fund that you save up in your bank account, stays in your bank account. Yes, it will lose money to inflation, but it's a cost of safety. That's about 3 to 6 months of your expenses. So if you spend $3,000 a month in bills or expenses, you should have $9,000 to $18,000 at least set aside for a rainy day. Many people say go to 12 months, but you don't need to. Those are people who want the extra safety blanket, or their job may be variable, so they may not be able to get a job if they're ever laid off or whatever the case may be. So this varies from case to case again, but at least 3 to 6 months, nothing less. An easy way to build out or to keep track of the emergency fund is to have a separate banking account for this emergency fund. You can have as many checking account or as many savings account as you want. So open up a savings or a checkings account and have that labeled as emergency fund. This way, every month, whenever you get paid, you can set a certain amount into that emergency fund to build that up. So if you want an emergency fund of $10,000, you can designate from every paycheck $500 to automatically go from your paycheck into that emergency fund. And then one day you'll have your emergency fund. But I would prioritize that before investing. Prioritize that before anything else. The next most important step in your roadmap should be paying off high interest debt. So there's a few different types of debt. First type is, like I said, high interest debt. This could be credit card debt, consumer debt, a lot of many other debts that carry 10, 20% interest. Low interest debt is something I consider like your mortgage. Your mortgage could be 4 or 5%. If you got lucky, it's 2.5%. Do not pay that off early. That is free money. And then you have other car debt or other debts like your car payments. Usually that's around 3 to 5%, so you can pay that off later. You don't have to rush to pay that off. The number one thing you should rush to pay off is any high interest debt. Anything over 10% especially. The difference that I categorize as high interest debt or low interest debt is depending on how much you can make on that money. So if you can take $100 and make 8% on this, but your debt is only at 3% interest, it doesn't make sense to pay off the interest because you're only getting 3% on that money. Instead, you can take that money to make 8% and pay off the debt and end up with the difference there. So that's a lot of math there. But let's say you have $100, you get charged 3% interest on that. Or you can take that same $100, put it in an investment that returns 8 to 10%, make $10, pay off the $3, and then you have a $7 profit. So that's an easy way to figure out whether you should pay off your debt or not. If the debt is less than what you can make on the money, do not pay off that debt. That money is more valuable investing. But if it's a consumer debt, 20%, definitely pay that off. Because if you're getting 20% returns on your investments, let me know. We'll talk and we'll figure something out because I need that. So now that you've understood your expenses and your income, you've created a budget, you've built out your emergency funds, and you paid off high interest debt, the next step is to max out your retirement account. Many people ask me, should I max out my 401k and invest $23,000 into it? That's up to you. But in my personal preference, I go up to the company's match. With a 401k, it is employer sponsored, and what they do sometimes is they'll match your money. So if I put 4% of my paycheck into the 401k, company will add another 4% on top of that. So it's a total of 8% for my 4% of contribution. This is 100% return on my money, so it's a can't miss. The minimum you should be investing into your 401k is at least the company's match. If you want to go higher than that, that's up to you. You're going to have more money in retirement. The next retirement account that you should be investing in is a Roth IRA. This is an individual retirement account which you do not need an employer for. You can open this without having an employee-sponsored plan. The thing is, this is a much lower limit than the 401k. Since the 401k is at $23,000 or $22,500, the Roth IRA only allows you to invest up to $6,500. So it is much less than investing in your 401k, but it is worth it. So definitely invest in both, at least in the employer's match, and try to max out your Roth IRA if you can. There's a few strategies to maxing out your Roth IRA. If you get a big bonus at work at the beginning of every single year, you can just go ahead, take $6,500 from that, put it in your Roth IRA, and let that grow for the rest of the year. Or you can split that up into paychecks. Say you have 12 paychecks, you get paid once a month. You can invest $500 every single month into that Roth IRA and have $6,000, and then at the end of the year, you add in an extra $500 and then you're maxed out. So the approach is really up to you. Research shows that it's actually more beneficial to lump sum all your money and put it in at once. But this may depend on how much money you have available, or if you actually want to go ahead and dollar cost average, like I said, break that up into 12 payments every single year. Build out your strategy, figure out how you want to do this, and max out that Roth IRA. Another retirement account that you can take advantage of is the health savings account, or the HSA. When we all get older, we're all going to have medical expenses, whether this is your eye exam, going through surgeries, or whatever the case may be. Hopefully we're all healthy, but that's life. We're all going to have medical expenses. The HSA is a tax advantage medical expense retirement account. So a cool thing with the HSA is similar to the 401k. If your employer offers this, you better take advantage of it. Some employers will actually put money in your HSA for free, and all you have to do is an annual physical. This is great because you're getting yearly checkups on your health and your body, and you're getting free money. So take advantage of that. Look into that if your employer offers that, and definitely get that exam and get that free money. Once you've went through the first couple steps of an emergency fund, paying off your high interest debt, saving up for retirement, you can do a few other approaches. You can start saving up for a rental property. You can invest in a normal brokerage account, or you can even open up your own side business. Whichever way you want to take it is up to you. Some people may not want to run a business, so they may just invest this in the stock market. Some people may want to become landlords and invest into real estate. So they take the real estate approach. Once you have all that emergency fund built up and you have your retirement account saved up, you can take whichever road you want. Now say that is the next step to building your wealth. Lastly, the last step to building your wealth is saving up for big expenses. If a big expense comes around that you know you want to build a house, you want to buy a house, you want to buy a new car, you want to buy a boat, you want to buy a second house, you have to pay for a wedding, whatever the case may be, saving up for these big expenses is crucial because you cannot just one day come up with all this money. So this is something you have to think years ahead to save up and build a plan. Say you want to buy a house in 5 years, set a plan on how much money you're going to need. Say you need $100,000. Set a plan to set aside money every single month for this expense. This way, when the day comes, you already have it there. You can just go to your account and you can take that out, and boom, you have your new house. You can follow the same approach, like I said, with the emergency fund account. You can build a separate bucket for every big expense. You can have a bucket for a boat. You can have an account for a new house. You can have an account for a wedding. Every single month, deposit some money into each of these buckets. This way, like I said, you're saving up for these big expenses. You're not going to be surprised when the day comes and you actually be able to move forward with these big expenses. So in conclusion, we went through some of the steps that are critical to your financial health. The first step in this roadmap is understanding what you're spending and what's coming in. Next, you want to build out a budget. Then have your emergency fund of 3 to 6 months, 12 months if you want. Once you have your emergency fund, pay off high interest debts, consumer debt, credit card debts, etc. Once you've paid off your debt, maximize your retirement accounts, your 401k, your HSA, your Roth IRA. And then once you've had a plan for all of that, you can go ahead, save up for the big expenses, your wedding, your car, your boat, your second house, and so on. So I hope this gave you some guidance on where to take your next financial steps and how to become financially wealthy, whatever that means to you. So thanks for tuning into this video. Hope you guys enjoyed it. Hope this helped you out. Like I said, if you guys need help with anything, feel free to reach out. Hit the subscribe button, hit the like button, and we'll see you guys in the next one.